Stock markets today. We're down on the low side at the moment. The CAC run off 0.4%, the SMI down 0.4%. The bank stocks, perhaps no surprise, bearing in mind the ongoing disagreements in Europe about what to do about the Eurozone debt crisis, is impacting the bank sector. Now, it's time for Investors Clinic. The rules are pretty easy. Email us, strictlymoney@cnbc.com, and then we got our guests to answer them. Besides Andy, we're also now joined by Gemma Stillerman, Head of Research at Credo Capital. I believe your first time, is it, on Investors Clinic?
Yes, it is.
Welcome,
Please be kind.
Gemma. Well, it's not me; it's the audience. I don't get to ask the questions on this. We do have someone who's written in about banks. Funnily enough, who said, I'm one of the duffers who invested heavily in RBS and Barclays just as they started falling around 2 years ago. What are my prospects now?
I mean, if you're looking at the UK economy, the European economy and the US economy, I think there are three things to watch. So, if this person's interested in maybe how they're going to trade the shares, you've got to look long-term at the economy. And there are three stages. There's lending, there's spending, and there's also job creating. And those three stages we really haven't seen yet for there to be a self-sustaining recovery. And that's one of the problems at the moment. In the UK, we're seeing one of the largest fiscal squeezes since World War II. With respect to spending, consumers still haven't got that confidence to spend. And with respect to job creating, I mean, in the UK, there are about 750,000 jobs at risk. And in the US, we saw on Friday, the job data came in, far under expectations.
The OBR's told us we're going to lose less public sector jobs, and the Engineers Employers Federation is saying they can't find people to hire.
But there's a lot of discrepancy, I agree, with what we're hearing anecdotally and also what we're hearing from the figures that are coming out. So, for example, if you just look at the figures that came out of the US, and we saw that unemployment rose from 9.6% to 9.8%, what it's hiding is the amount of people that have given up or have moved part-time. Yeah. And with those figures included, it's actually 17%, which is a very, very high figure. And if you look in Europe, there's a high percentage of youth unemployment there. So although people are out there, yes, they're looking to increase workers, you still need to have, still deleveraging.
Yeah, all of which means if I own RBS and Barclays and I'm sitting on a loss, what do? Take the loss or say, OK, lock them away for, how long do I have to lock them away for before we get the money back?
I think there's a big discrepancy between what's going on in the economy and what's going on in the stock markets. So whereas we might be slightly more cautious and there's a lot of reason for concern with respect to the economy, the stock markets themselves, you've seen a higher risk premium, which is elevated at the moment, and just, as we know from Warren Buffett, etc., that's the time that actually you go into the markets, is when they're pessimistic. Secondly, there's this search for yield, and that should hopefully support markets. So you've got a lot of cash on the sidelines, looking to get in. You've got equity yield, as I said, versus cash is looking attractive, but also versus government bonds is looking attractive. Corporate debt, the spreads have narrowed by, I think it's about 65% now since the peak. And then versus high yield, there's also been a recovery in high yield, much more so than equities. And on top of that, you've actually seen a lot of consumer discretionary names kind of leading the rally in the equity markets. So yes, you may have been hit on these stocks, but actually this is maybe the time to actually hold it, and hopefully they'll recover.
Well, I think that's right. I mean, if you take the long-term view as well, but I think right now for somebody sitting on losses, on domestic banks particularly, I think that you've got to have a sense of reality about this. The likelihood of recovery in the fundamental economy with lending conditions appropriate for a recovery on the top line in bank sector is looking further and further away. Don't forget next year as well, 2011, and thereafter you've got the impact of Basel III, talk about Basel IV, you've got Dodd-Frank in the United States, you've got massive regulatory tightening. So, I mean, it might have been once upon a time that banks were kind of sleep well at night, stocks. Yeah. They're not,
Exactly, and actually there was a quote that came out, I don't know how many months ago, that said that there's been a lot of work on the banks, there's been a lot of, obviously, stimulus, but the lending capacity of the banks is still heavily impaired, and it will take years to recover.
Go and have a look at banks that are, exposed to China and the Asian growth economies. If, that's the old traditional model. That's where you wanted banks. That's why you bought RBS many years ago, and so on. Go look at banks that are exposed to the growth territories.
OK, another question Alex has written and says, what are the chances that Germany might end up leaving the euro? Some have suggested.
I mean, I think there are quite a few issues that are in play. I mean, you had Merkel herself come out and say that the failure of the euro is a failure of European unity, and it's become a very political subject. So you know,
it always was political, though.
It obviously was very, very political, but it's more so on the fact that they want to, you know, contain the contagion, and that actually those that would exit the euro and those that would remain in the euro would both be punished. So those that would exit, you know, you'd have this contagion, you'd have this flight of capital. Yes, on the one hand, that it would help regain their competitiveness because their currency would devalue, but you know, if you look, bringing it back to actually the UK, I mean, and actually the UK versus Ireland, because obviously that was one of the topics that came up recently. The UK exposure to Irish banks is actually 140 billion pounds, and actually, if the euro collapsed, they'd look at losses of about 67 billion pounds. So, you know, you've also got to look at what would this, you know, involve as well.
The same thing would happen for the German financials. That's a no, then. I take it. No, that's a no.
Yeah, I think that's right. I think it's just, I mean, for want of any other argument, there's just too much political capital vested in the project. And I think that if you take that view, that it's a no to Germany leaving the euro, then go and have a look at some of the peripheral country bonds. You know, if you've got the risk appetite for it and it's a high risk strategy, go and look for a second round of convergence plays, which is what we had on the lead into the euro, of course.
And actually I think there's something to exploit here as well, because it's always interesting whether you agree with something or don't agree with something. It's interesting to note what's the opportunity to exploit. And even though we've obviously heard a lot of talk about France on one side, Germany on the other, there is something that they both agree on, and it's the fact that markets at the moment tending to be a little bit irrational. And during a time when markets are being irrational, there is this opportunity to exploit that.
All right, another question here. Bearing in mind China trying to slow down their economy, should we be taking profits on the mining stocks at this time?
I'm talking about emerging markets actually as a whole. I think there is this risk of, I've said this before, but there is a risk of over-exuberance. So, you know, maybe it is the time. If we look at where valuations have gone from the March lows, they've rallied. The emerging market index has rallied, you know, about 135%. So even though we're talking about that's the long-term growth drivers, there are still a lot of potential long-term in emerging markets. You're looking at, you know, stronger balance sheets, a higher level of savings, you know, 75% of the foreign exchange reserves. I mean, they've got a wider range of policy tools available to them. But when we talk about stock specific, yeah, valuations are starting to look a bit more stretched. There's reputational risks. As we've heard, you know, China and inflation, are the inflation numbers perhaps slightly higher than they're coming through at? And maybe this is a time to just, you know, try and reevaluate and not get swept up in too much overexcitement about certain economies, and maybe take profits from that and look at different ways, and maybe stocks that have underperformed the wider emerging market index that will be able to extract alpha from this type of trade.
I think for as long as you've got discussion about QE continuing through 2011, you'll still have funds flow through to the emerging markets. I think that what's interesting now is people looking beyond the traditional BRICS, the BRIC territories, beyond immediately emerging Europe into some of the further developed, lesser developed economies for 2011 and beyond. And I'm starting to see a lot of positive calls, not only on Russia, but also places like Turkey, Indonesia, and so on. Again, for those with the appropriate risk appetite, that might be the next area to look for consumption plays.
I would actually just say one word of warning actually on that, because we have seen, as you mentioned, we've seen the BRICS, we're now hearing about Indonesia, there's also the CIVETS. I think that's going to be, you know, the next acronym. But I would warn about, as I said, this
China, India.
It's Colombia, Indonesia, Vietnam, Egypt.
Oh yes.
Turkey, and South Africa.
It's like more frontier.
Yeah, more frontier. But I would kind of warn against this risk of looking just at an acronym, and you know, a pithy abbreviation doesn't necessarily equate to a profitable investment.
You surprise me. Good to see you, Gemma. Thanks very much for joining us. Gemma Stillerman, even, Head of Research at Credo Capital. Good to have you on. Come back. Thank you very much. Andy sticks around. Right, we'll turn attention to what's happening on the currency markets today.